2 days ago, 6 of the largest financial institutions on Earth agreed to help create more than $500 billion of financing. That sentence probably sounds like somebody is rescuing a bank. They aren't. The money isn't being assembled to save a country, refinance the United States government, or prevent another financial crisis. It's being created to help companies buy computers. Very, very expensive computers. And the company sitting in the middle of all of this is NVIDIA. On August 10th, NVIDIA announced partnerships with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to establish financing platforms intended to mobilize more than $500 billion of outside capital for AI infrastructure over time. Now, there is an important distinction here. NVIDIA did not raise $500 billion. Jensen Huang did not walk into Goldman Sachs on Monday afternoon and leave with a check containing an unreasonable number of zeros. These are proposed financing platforms. The financial institutions are supposed to independently underwrite investments and bring outside money into AI data centers, computing equipment, and the infrastructure surrounding them. But the fact that this system is being created at all tells us something very interesting about the AI boom. The industry has developed a new problem. It isn't finding people who want NVIDIA's chips. It is finding enough people who can afford to keep buying them at the scale NVIDIA now needs. NVIDIA Investor Relations. And that sounds strange because NVIDIA is doing unbelievably well. Its latest reported quarter produced $81.6 billion in revenue. Data center revenue alone reached $75.2 billion, up 92% from the year before. Those are not the financial results of a company desperately searching for customers. NVIDIA is selling an extraordinary amount of equipment. The problem is what happens next. NVIDIA Investor Relations. AI has become incredibly expensive. Not expensive in the normal Silicon Valley sense, where a startup hires 20 engineers, rents a nice office, and accidentally spends $70,000 on kombucha. We are talking about an infrastructure boom. When a company decides it wants serious AI computing capacity, it doesn't simply order a few GPUs from Amazon and place them under somebody's desk. It needs land, a data center, electrical connections, transformers, cooling systems, networking equipment, backup power, thousands of processors, and increasingly, dedicated power infrastructure capable of feeding all of it. By the time the computers arrive, you have effectively built a small industrial facility whose main purpose is to ask a chatbot questions extremely quickly. And every part of this costs money. A lot of money. This has become important enough that NVIDIA now warns its own investors about it. Buried inside the company's latest quarterly filing is an unusually revealing sentence. NVIDIA says the availability of data centers, energy, and capital to support its customers' AI infrastructure is crucial to NVIDIA's future revenue. Capital. That word matters. Imagine that I own the greatest construction equipment company in the world. Every contractor wants my excavators. My excavators dig twice as fast as everybody else's. Wonderful. Then I decide that each excavator costs $50 million. Suddenly I have a slightly different business problem. Contractors still want the machines. They simply cannot casually pay for 12 of them. At that point, selling more excavators starts depending on somebody else's ability to provide financing. And this is where Wall Street enters the story. The 6 firms working with NVIDIA manage or control access to enormous pools of capital. Pension funds, insurers, private credit investors, infrastructure funds, and other institutions are constantly searching for assets capable of producing long-term returns. NVIDIA believes AI compute can become one of those assets, not metaphorically. The company is explicitly trying to turn AI computing infrastructure into an investable asset class. That may be the most important part of this announcement. For most of NVIDIA's history, a chip was a product. NVIDIA manufactured it. Somebody bought it. NVIDIA booked the revenue. Done. But the AI industry is starting to look at GPUs differently. A rack of expensive processors inside a data center can generate computing capacity. That capacity can be rented to an AI company. The AI company uses it to train models or serve customers. Those customers create revenue. So Wall Street can look at the machine sitting inside the building and ask a very Wall Street question. Can we lend against this? Apparently, the answer is increasingly yes. Goldman Sachs says part of the opportunity is creating a market for credit backed by NVIDIA compute. Recent reporting on the structure says GPU-backed financing and securitization could become an important part of the system. This is where things start getting strange, because we may be watching computer chips slowly become financial products. Consider a commercial airplane. An airline does not always arrive at Boeing with several $100 million sitting in a suitcase. Aircraft can be financed. A lender is willing to provide money partly because the airplane is an income-producing asset. It carries passengers, passengers buy tickets, and those ticket sales help repay the financing. If the airline runs into trouble, the aircraft itself still has some value. Commercial property works similarly. So does industrial equipment. AI wants to do this with compute. A company builds an AI data center, installs NVIDIA systems, rents the computing power to customers, and uses that revenue to support the financing. Suddenly, the GPU is not merely something a technology company purchases. It begins to resemble collateral. And NVIDIA would very much like investors to believe this collateral will remain valuable for a long time. That is where CUDA becomes important. NVIDIA argues that its software ecosystem makes its compute broadly usable and allows infrastructure to be redeployed between different workloads and customers. The better that argument holds up, the easier it becomes for investors to treat the equipment as something with durable economic value, rather than an expensive computer that becomes outdated the moment Jensen Huang walks onto a stage wearing another leather jacket. And if this financing model works, NVIDIA gets something incredibly valuable. More customers can afford NVIDIA infrastructure. Suppose a smaller cloud company wants to build a $5 billion AI facility. The demand might exist. The customers might exist. The business plan might even make sense. But that company does not necessarily have $5 billion sitting in the bank. Without financing, the project doesn't happen. If the project doesn't happen, NVIDIA doesn't sell the equipment. Now put Apollo, BlackRock, or KKR between the customer and that problem. Outside investors provide capital. The facility gets built. The customer receives computing capacity. NVIDIA sells the systems. Everybody is happy. At least, that is how the PowerPoint presentation ends. And this is not NVIDIA's first attempt to solve this problem. In July, the company announced another model involving AI cloud providers in which NVIDIA can offer economic alignment, including credit support. The cloud provider buys NVIDIA infrastructure and sells computing services to customers. NVIDIA receives its normal hardware revenue and can also receive a share of the revenue produced by the supported cloud capacity. Think about how unusual that is. The company selling you the equipment can help make the financing possible, sell you the equipment, and then participate in some of the revenue generated by the equipment. This can make perfect business sense. But it also explains why people have started talking about circular financing inside AI. NVIDIA invests across the AI ecosystem. AI companies use capital to build infrastructure. That infrastructure contains NVIDIA products. NVIDIA receives revenue from selling those products. Then growing NVIDIA revenue makes the entire AI ecosystem look stronger, encouraging even more investment. That does not automatically mean anything fraudulent or artificial is happening. Plenty of industries use vendor financing, strategic investments, and customer support. The interesting question is much simpler. How much of today's extraordinary AI spending ultimately depends on tomorrow's AI revenue actually appearing? Because eventually, somebody outside the circle has to pay. You can move money between NVIDIA, a cloud company, a private credit fund, and a data center operator all day. At some point, an actual customer has to purchase enough AI services to justify the building, the electricity, the GPUs, and the financing underneath them. That is the part nobody can manufacture with financial engineering. And the amount of money required is becoming enormous. The Bank for International Settlements has been warning that the AI infrastructure boom is increasingly moving away from being financed entirely through technology companies' enormous cash flows and toward debt and private credit. Some financing is happening directly on company balance sheets. Some is being structured outside them through special entities and private credit arrangements. The BIS describes some of these off-balance sheet structures as economically similar to borrowing, and says they create stronger financial links between AI companies, private credit funds, and insurers. This is not necessarily bad. Debt is one of the main reasons modern civilization exists. If every railway company had been required to save the entire cost of a railroad before laying the first piece of track, we would probably still be waiting for somebody to finish Ohio. Infrastructure is expensive upfront and hopefully productive for many years afterward. Borrowing allows society to build the asset now and repay the cost using the income the asset produces later. AI could follow exactly that pattern. Imagine the optimistic version. Demand for AI continues growing. Companies use more agents. Businesses automate more work. Scientific computing expands. Robotics grows. Governments build national AI infrastructure. The data centers being constructed today stay busy for years. They generate enormous amounts of revenue. The loans are repaid. Investors earn attractive returns. NVIDIA sells enormous quantities of hardware. And everybody looks back at 2026 and wonders why anyone thought $500 billion sounded like a large number. That could happen. But infrastructure booms have another habit. Sometimes the thing being built really does change the world, and investors still lose an unbelievable amount of money. Railroads changed civilization. Railroad investors still managed to go bankrupt. The internet transformed virtually every industry on Earth. That did not stop hundreds of dot-com companies from disappearing. Fiber optic networks were essential to the modern internet. During the telecom boom, companies still built too much capacity, borrowed too much money, and discovered that a useful technology does not automatically make every investment in that technology profitable. That distinction is extremely important. AI can be revolutionary, and AI infrastructure can still be overbuilt. Both things can be true at the same time. The risk becomes more interesting when you look at the collateral. An airport can last for decades. A power plant can operate for decades. A railroad track does not wake up on Tuesday morning and discover that a new railroad track is 4 times faster. GPUs are different. Technology improves extremely quickly. Recent academic work examining NVIDIA's data center processors found very rapid improvements in computing performance across generations. NVIDIA itself continuously markets new platforms, partly on the basis of better performance and lower cost per unit of computation. The BIS has specifically warned that growing debt and circular financial stakes in AI infrastructure could create fragility, including the risk that specialized assets have to be sold during a downturn. And NVIDIA appears to understand the concern. One reason the new structure is interesting is that these financing platforms are meant to be independently underwritten by the financial firms, rather than simply having NVIDIA finance every customer itself. Recent reporting suggests NVIDIA may still provide limited residual value support in some projects, but the major financing decisions and much of the capital risk would sit with sophisticated outside investors. In other words, NVIDIA wants Wall Street to decide whether these projects deserve funding. That helps NVIDIA in 2 ways. And NVIDIA is helping build the bridge connecting the two. That is a much bigger story than another funding announcement. Because once an industry starts depending on credit, the rules change. When you're spending cash, the main question is whether you still have enough cash. When you're borrowing money, somebody eventually expects to be repaid. Suddenly, interest rates matter more. Utilization matters more. The resale value of equipment matters more. Customer contracts matter more. And most importantly, cash flow matters more. You can convince equity investors that a revolutionary future is coming for quite a long time. A loan eventually has a payment date. 20 years from now, pension funds might hold AI compute investments as casually as they hold airports, utilities, and commercial property. The $500 billion announcement could end up looking less like financial excess and more like the moment AI infrastructure finally grew up. But there is another version of the story. One where cheap financing allows companies to build far more computing capacity than the market can profitably use. One where newer hardware arrives faster than lenders expected. One where compute prices fall as competition increases. And one where the companies that finance today's most valuable GPUs discover that yesterday's revolutionary technology has a much lower resale value than the spreadsheet predicted. We don't know which version we're getting yet. And that's exactly what makes this so interesting. NVIDIA began the AI boom, selling the picks and shovels. Then it started investing in some of the miners. Then it started helping those miners find financing. And now it is working with Wall Street to turn the shovels themselves into an investable asset. That is an extraordinary evolution for a company that used to be best known for helping teenagers get better graphics in video games, and perhaps it works brilliantly. NVIDIA's numbers certainly show that demand today is very real. But the next stage of the AI boom will not be decided simply by how many GPUs NVIDIA can manufacture. It will be decided by whether all of the businesses borrowing enormous amounts of money to buy those GPUs can eventually produce enough income to pay for them. Because Wall Street has now found another $500 billion for artificial intelligence. The harder part begins after the money arrives.